Hey everyone, and welcome. We're about to take a hard look at one of the most sacred rules in personal finance. You know the one, you've probably heard it a million times. But what if I told you this so-called golden rule is actually a trap?
Yep, that's the big question we're diving into today. We're going to explore how this super simple, smart-sounding advice might just be a slow burn problem, the kind that quietly sabotages your financial future when you're not even looking.
All right, so first up, let's make sure we're all on the same page about the rule we're talking about. It's that one piece of advice that's basically become the bedrock of retirement saving for millions of people.
I mean, you've heard it everywhere, right? From financial gurus on TV, from your parents, maybe even from your boss. It's repeated so often that questioning it feels like you're breaking some kind of financial law. It's always pitched as the one simple trick to secure your future.
And you know what? That's exactly why it's so popular. It's a really simple instruction in a world full of complex financial decisions. Following it makes you feel like, okay, I'm doing the right thing, I'm on track. But that's where things start to get a little complicated.
So now let's start peeling back the layers. Because a lot of the time, flawed advice hides in plain sight, disguised as common wisdom. And this particular piece of advice might just be the most widespread example out there.
You see, the problem here isn't that it's going to cause some huge dramatic crash in your portfolio. Oh no, it's way sneakier than that. Think of it more like a slow leak in a tire. It's a portfolio that just quietly underperforms year after year for decades, all while you think you're doing everything right.
And look, this isn't necessarily a problem for everyone, but for certain folks, it is a huge potential issue. I'm talking about high earners, business owners, or hey, anyone out there who dreams of retiring before they hit 60. For you, this one-size-fits-all advice can actually work directly against your biggest goals.
So, what are the actual problems? Let's break it down. We're going to pull back the curtain on the 3 hidden dangers of putting all your faith and all your money into a 401k.
So what we've got is first, a tax trap. Second, a major flexibility problem. And third, something I like to call the inheritance bomb. Trust me, any one of these can seriously derail your long-term financial plans.
Okay, danger number 1, the tax trap. When you lock every spare dollar into a tax-deferred 401k, you're missing out on the really powerful strategic moves you can make in a taxable brokerage account. We're talking about smart stuff like capital gains harvesting, that's selling some investments at a loss to offset your gains, and income smoothing, which helps you manage your tax bracket when you retire.
Second is the flexibility problem, and wow, this is a big one. Want to start a business? Invest in real estate? Maybe retire at 55? Well, good luck. That money is essentially locked away until you're 59 and a half. If you try to touch it early, you're going to get hit with some pretty hefty penalties.
And third, we have the inheritance bomb. Thanks to some fairly recent changes in IRS rules, that amazing nest egg you've worked so hard to build could turn into a total tax nightmare for your kids. They might actually be forced to withdraw the entire amount within just 10 years, which could trigger a massive and probably very unexpected tax bill.
Let's just put a number on it to make it feel real. Imagine you did everything right, you saved diligently, and you grew your 401k to $2 million. I mean, that's a huge accomplishment. But under these new rules, that incredible gift could become a massive tax burden for your loved ones. So, what's the alternative?
And that's really what this is all about. It's not about telling you not to save. Not at all. It's about saving smarter, with a much more balanced and strategic approach. Okay, let's be crystal clear about one thing. If your employer offers a match, you absolutely contribute enough to get every single dollar of it. That is a 100% return on your investment right there. It's free money, and you should never, ever leave free money on the table.
Now, once you've got that match, this is where the real strategy comes in. The old rule was simple. Put all your eggs in that one 401k basket. But the smart strategy is about balance. It's about layering different types of accounts, your 401k, a Roth IRA, and a taxable account, to give you tax diversity and, most importantly, flexibility. And this is a perfect illustration of why that flexibility matters so much. Let's say you want to retire at 55. Awesome, but wait. Your 401k is locked for another 4.5 years. The taxable account is what bridges that gap. It's the accessible fund that finances your life until your traditional retirement accounts become penalty-free. So, what's the big idea you should walk away with here? It's really a shift in your mindset from just saving to saving with a clear, strategic purpose.
The key concept here is something called strategic retirement layering. It's all about building a portfolio with different layers where each layer has a specific job. You've got your tax-deferred 401k, your tax-free Roth, and your flexible taxable account, all working together in harmony to give you the most control and the best tax efficiency.
And that is the absolute core of this whole idea. The ultimate goal isn't just to stack up the biggest number possible in one account. It's about financial agility. It's about having the right kind of money accessible at the right time in your life so you can actually achieve your goals. So I'll leave you with this thought to chew on. If this piece of common wisdom turned out to be so flawed, what other financial rules are you following without even questioning them? Makes you think, right? Thanks for tuning in.